Good afternoon, everyone. I'm Roger Dix. I'm the Chief Risk Officer of the Wesleyan Insurance Society, and it's my pleasure and privilege to be your host and moderator for this discussion today online. Thank you for joining us, and it's this, in case you had any doubts, this webinar is called The Future of Insurance Products, What Will Determine Price. Now, besides watching us on screen, and we're quite happy to speak all for the whole hour non-stop if that's what you want, but hopefully you'll stop us from doing that because you want to ask some questions. So at the bottom of your screen, that's where it is on mine, I think it is on yours as well, you've got something called Q&A. You can put your questions in there, and then we'll be able to pick them up, and every now and again we'll sweep up what questions are there, and I'll put them to the panel to see what answers are there. There's no stupid questions, there's only us giving stupid answers. So please do all you can to provide us with questions, and then we can make the webinar much more what you want rather than what we're just going to talk to you about. We've got a good range of topics to ask ourselves questions on, but let's see where it goes. Right, that's enough from me for now. I'd just like to ask my panel to introduce themselves. So since I can see them first on screen, it's Kevin.
Hello, my name is Kjetil Christensen, and I work for SAS Institute out of Oslo in Norway. I started my career as a life actuary, and after that I worked for many years with commodity trading. The last 8 years I worked for SAS Institute, and there my focus has been on P&C insurance. In the previous years, we have seen increased price transparency for products like motor insurance and home insurance. In many countries, this has forced insurers to apply new techniques for premium calculation to stay competitive and still make money. Today, I hope that I can shed some light on what we at SAS have learned from implementation projects where the aim has been to improve pricing. Thank you.
Thanks very much. Can I ask Tabile to introduce yourself?
Thank you so much, Roger. Good day, good evening, morning, wherever you are. I am Tabile Nyaba. I am the Chief Risk Officer of Old Mutual Insure. I'm based in South Africa, Johannesburg. So I am responsible for governance, risk compliance, forensics, and combined assurance. And just before, 2 weeks before the lockdown, I was actually given the responsibility of business resilience. So I have been assisting the organization to navigate through this COVID since then. And, in August, I was then appointed as the president of EMSA, which is the Institute of Institute of Risk Management South Africa. Thank you so much, and we're hoping and we're looking forward to spending time with you on this webinar.
Thank you very much. And last but by no means least, Joseph.
Hi, my name is Joseph Liu. I work for Legal & General in London. My job title is the Director of Longevity Science. I have been involved in developing longevity assumptions for the purposes of pricing in annuities. And I've been involved in developing and implementing real-time and more individualized pricing for our annuitants based on their health and medical information. Thank you.
Okay, thanks very much. Right, let's move to the first of our questions, if I can manage the technology, which I think I can. Right, so the first question is sort of, how will customer loyalty be? Will it be harder to obtain customer loyalty, if indeed there's any there, I might cynically say, when premiums are compared in real time? So Tabile, you first and your perspective of this, please.
Thank you so much, Roger. Yes, I think as the insurers, we're actually seeing a rapidly changing and growing trends and around the behaviors of our customers, which then certainly informs the pricing and also informs the loyalty of our clients. So what we are actually seeing is the expectations from clients or customers. They're expecting high usage of technology. They also expect a speed in service and concluding transactions very quickly, about 5 minutes. If it's longer than that, they are out. And then they also want that flexibility to chop and change, as they wish on their insurance covers. And then we are certainly seeing that we're moving towards having the real-time comparison of premiums. And when it comes to the personalized insurance covers, so we are seeing that they might just be the trend going forward. So with this, it becomes a challenge, but an exciting challenge for the insurers, to actually to tap into the loyalty So in my view, in order to retain the loyalty of the customers, we have to understand their needs. So we have to understand, what their behaviors are, and now we have to have this on the real-time basis. And it's not really about, I say this, that it's not about the biggest fish that eats the smallest fish, but it's the fastest that eats the slowest, basically. And it's not about the company's brand and advertising, but more about the customer experience and their ability to share their experiences. So in order to maintain that loyalty, we have to be able to give our customers that experience that they will be able to share with other people, because nowadays the word of mouth seems to be the best marketing strategy for organizations. And indeed, as well, it's got to be about value adding on the side of the insurer. The customers need to see or feel like they are actually getting value for money, basically. So we're actually seeing that it might be a bit of a challenge to maintain that loyalty, but there are definitely some means and ways of the different insurers to maintain that the loyalty. Thanks, Roger.
Thank you. Joseph, what's your thoughts on this one, please?
Yes, can we keep customers' loyalty? Yes, I think so, but it's harder because if you have 5 prices on the screen, and if the company's price is number 5 of the 5, it's I think the customer needs a bit of explaining and rationalizing to actually pick the least the most expensive one. But at the same time, customers might have had good experiences with the existing provider. They might want to stay for peace of mind or the fear of getting things wrong, but at an acceptable premium. We have seen us winning businesses when our prices were not the cheapest. At the same time, we have also seen us losing businesses when our price were actually the most competitive. So I think it shows that there's still some elements of behavioral selection other than pricing that is at play that is going to be quite interesting to understand and analyze.
Joseph, can I just come back?
So,
you mentioned that great word behavioral there. Now, if I look at my own actions, when I go onto sort of websites for insurance, then if it's a commodity, then economic theory says I should go for the cheapest. But I don't always do that because if I don't know the name of the company at the top, then I probably won't go there. So I'll probably stick to a company I know. So Legal & General in the UK is a very well-known, loved brand. So do you get any gain for that? Do you actually include that in your pricing at all? Or is it behavioural? We're still trying to get to grips with what behavioural means to people.
Yeah, I think we are still trying to understand it more. We do speculate that we have that advantage because we have served many customers for many years. Do we price it in? We try to be as competitive as possible. So if there's anything, there's quite minimal. So I do agree with you. There's a lot that we can understand that we still yet to understand about behavioral selection when choosing products.
Okay, that's great.
But at the same time, we've seen customers going to other firms that they're potentially not with more expensive prices. So that's it can go both ways.
Yeah, no, it can be an interesting one there. Kettle, any particular thoughts on this one before I ask you to lead on the next question, which I'll bring up shortly?
No, I think there are very good points mentioned here. And I also think that from an analytical perspective, being able to combine the traditional actuarial techniques with more customer behavior models is one way to analytically being able to price products in this modern world where prices can be compared online.
Okay, well, let's move on to the next one. So if we start moving into what I call pure economic theory, then for commodity products, then how can we avoid a price war? So, Kettle, you to lead off on this one for us, please.
Thank you, Roger. I think actually it's very hard to avoid a price war. There are obviously differences in how aggressive such a war will be played out in different countries, but in countries like Spain, Portugal, and Greece, there has been a substantial drop in average premium for products like motor insurance, home insurance, and health insurance after the introduction of price comparison websites. And I also think under such circumstances, insurers need to meet their competitors face-to-face when they are met with price competition. And the best way to win a price war is for the insurance companies to better understand risks in their portfolio and understand the risk they assume at different price levels. And I think a lot can be done by improving the methodology which is used for pricing. We've seen through a lot of proof of concept studies we have performed together with our insurance customers, in SAS Institute's insurance customers, that traditional statistical models cannot adequately differentiate the risk in insurance portfolios. But when more advanced machine learning models are applied, the loss ratio is lowered substantially. And I also think that an increasingly important question for insurance companies is sustainability, and this goes back to what Tabila mentioned, that an important component of this is a strong long-term customer relationship. And in this context, insurers should focus on claims prevention for existing customers with high risk. And again, we see that modern machine learning techniques do this better than traditional statistical methods. When insurance companies identify these customers with high risk and work proactively with them to reduce the risk factors that could lead to more claims, they also make these customers more profitable. And I also think if you spend some time thinking about what profitable actually means, profitable can mean a lot of different things. Product managers in insurance company might focus solely on loss ratio in their individual product lines, but increasingly we see a focus among our customers on customer lifetime values. And if you focus on that, the goal is to identify and attract and retain the customers, which give the largest net present values across all different product lines for their whole lifespan of the customer relationship. And to do this, as I mentioned when you asked the previous question, I think that both actuarial models and customer behavior models need to be integrated. And combining this into one system, I think insurance companies will have a strong quantitative advantage to base their strategic decisions on. Thank you.
Okay, thanks very much. Tabile, we notice you're back with us on screen now, so I'll take advantage of this to say what's your thoughts on this, please, particularly from the South African perspective. I think let's take advantage of the fact we've got a really international panel here. So let's learn from each other's countries and how it operates, because what happens in UK and Norway or Europe might be totally different to South Africa.
Thanks, Roger. I disappeared a bit. I just put on the comment there that I disappeared. Are we on the second question?
Yes, we're on how can we avoid a price war?
Yeah, I actually just listened to what Ketel was saying, and I kind of like concur with him. And maybe at this point in time, I don't have much to actually add, except that, like the bit that I actually got from him is kind of like aligned with what is happening down here.
Okay, that's fine. Thank you. Joseph, your perspective, particularly in the space of longevity mortality, where you're expert in.
Yes, and I think even more easily if there's only one price, there's limited prices. For example, there's one price for someone age 65 and 5 companies, and very quickly we'll try to really reduce the price to attract customers. But what we have the approach in the UK is that we don't have just one price for someone age 65. There are at least 200 prices depending on their health conditions, socioeconomic status, severity of diseases, and a combination of all these. So as a result, so there's tough competition, but there are different firms can have different niche, different emphasis, and different expertise to serve different segments of the customers. So it becomes is a multi-segmented business rather than just one commodity. So I think that is one way that we can serve the customers without necessarily going to a price war. We can serve competitively and yet have pockets of expertise in different risk segment areas.
Okay, Tabile, can I come back to you on sort of the more general point? So the question's two parts. We've dealt very well with the first part, which is how can insurers identify and keep the most profitable customers? But what about and avoid underwriting customers that are higher risk? How do we ensure that a price war then doesn't inadvertently, possibly being generous, exclude those who've got higher risk or are going to be high price? So what's the balance between underwrite for what you want and the public interest that we provide a public service and do it that way? How do you see that one?
Yeah, so it's actually quite a tricky one, considering actually that the competitors' prices ultimately affect how much we can sell, but reactionary pricing is not ideal. So we believe that building a strong information on our customers' price sensitivity is the way to go, and then add value to the product without actually increasing the prices, and then advertising on our competitive would also be one of the areas that we can work on as well, rather than maybe on the prices itself.
Okay, fine. Let's move to the next question now, as it sort of links to it. I'll go back to Kettle on this one. So, could personalised premiums be the future of the industry? Now, we've heard today that there seems to be personalised pricing in, whatever that might mean. But I still come back to my public interest need, desire, want, that some people are going to be very expensive to insure. And at what point does some form of cap or sort of mutuality come in to do it there? So, Kettle, how do you see this one, please?
Well, I think personalized premiums, or at least individual premiums for different customer segments, will be increasingly used by the insurance industry. But I also think that this is done quite a lot already today. But I think there is it's possible to make this segmentation even finer and do the pricing in a more analytical manner. To do more personalized pricing, I think more data types will in many cases be required. I'm speaking here from a P&C perspective, so I will not comment on life insurance. But I believe that data acquisition should be central to any insurance company strategy. And I think some of the companies posing the most significant threats to legacy insurers already have significant amount of data that allow them to understand customers and quantify their risk. These are companies that are not insurance companies, doesn't have insurance company as a core business. But companies like Alibaba, Amazon, and Tesla, I think, are good examples of this. The data these companies possess allow them to calculate insurance premium at a much more granular level than what is possible for most insurance companies. But I also see that data acquisition doesn't have to take that much time. We see firms specializing in this. In Germany, for instance, insurance companies are collaborating with local firms that specializes in detailed demographic data, so that the data acquisition doesn't need to take place organically. It can actually be bought on the market. And regarding new data types, I also think that we will see telematics data introduced for claims management and premium calculations for motor insurance. This data can be obtained by specially installed hardware, which I think we will see in many modern cars, or it could be also be acquired by smartphone use, for instance. One example from Sweden, my neighbor country, is that the insurance companies now offer premium discounts to holders of home insurance policies that agree to install water leakage monitors. These are monitors that will detect if there is a risk of water damage to the insured property, and these monitors will likely lower the expected claim costs for the insurer. Another important topic when it comes to personalized premium is the price sensitivity for policyholder. especially for commoditized policies like motor insurance, for instance. In SAS, we have worked quite extensively with the insurance industry with something we call portfolio optimization. Here we price each individual policy so that it maximizes the profit for the insurer. And being able to estimate the price sensitivity of both the current and the potential policyholders, I think is a very important input to profit computation. And I think in a market with high premium volatility, which we have seen in especially in Southern Europe, being able to price insurance products dynamically will be a huge advantage. Thank you.
Okay, we've had a question in from the audience, thank you. And I can put it straight to you, Kjetil, which is technical innovation. What's the balance between the benefits and the risks attached to it? Because it's clearly there's going to be benefits from it, but do we understand the risk? Are we managing those well? What's your thoughts there?
Well, I think that the technical innovations will be there anyway, so you cannot really choose to ignore it. I think many of these new topics that we see in especially motor insurance, they will happen anyway. So you cannot choose to look away from it. You need to cope with it, and you need to be able to take this into account when you set premiums for your policyholders. When it comes to price comparison websites and the transparency in the market, we see a lot of we see the European market being very, very different. In the Nordic region, where I'm based, there is no transparency at all in the market. The commoditized motor insurance policy is not there yet. Different companies offer different terms and conditions, and they have and the introduction of price comparison websites have not materialized. Whereas in other countries like Southern Europe, UK, Germany, there is a lot more competition. So maybe in a world where there are not much transparency, maybe you don't have to take the technological innovations into account in the same way. But I think once prices and data is available to everyone, I think you cannot simply look away.
Okay, thanks for that. So Joseph, we've moved to you now. So from your earlier answer, so it's a yes to personalised premiums in mortality. And I suppose the question to you is more, how personalised can we get or should we get? And that sort of links in. And also the technological innovations. Are they giving us false information possibly? So a whole range for you to go for there in your space.
Yeah. How personalised can we get? I think we can allow for many diseases and severity, and the model will then naturally fit people quite well personally. It just reminds me of going to shop for a pair of shoes. I'll go there and say, hey, I found my shoe, it fits me well, it's personalized, it's size 8, and somebody watching me. So it's not because the company is trying to be personalize my need, but they've provided a range of shoe sizes to fit the population. So from health and longevity perspective, we know that people have a wide range of life expectancy depending on socioeconomic status and health status. And our algorithm allow us to accommodate them based on evidence that we have. So I think they realize that buying a pair of shoes because we can allow for many prices. That the challenge is more about analyzing our own data to understand differences in death rates among a wide range of people within the society, and also understanding medical data to understand the increase in death rates as a result of health and medical problems. So it is this technical challenge that we need to bring together to fit them. So we see this as segmentation of risk. Go back to your questions about how do we avoid risk, how do we attract different risk. The solution that we have taken is to provide an as accurate understanding of risk as possible, and through that, it will naturally price people with higher risk. In our case, it's people who could potentially live longer. There'll be higher prices for them, and lower price for people who have a higher risk of dying in the shorter term. So that will place it to the market, and then the interaction will happen in the markets. In terms of technological advancements, yes, we need to have data analytics, modeling, the generalized linear statistical model. And if you give some steroid to them, they become machine learning. You have 5 models instead of 1. We need to have a good grasp of medical literature. So we have to be able to have the ability to scan through what have been published in different fields, such as cancer, cardiovascular diseases, neurological diseases, and have the ability to screen out what is relevant to our business, and which is death rates or life expectancy, and then eventually use them and model them. So it's a multidisciplinary expertise challenge. And in terms of technical challenge, we need to be able to bring all this together, combine with the actuarial calculations, discount rates, inflation, and so on, and provide the customer a price within 10 seconds. At the same time, comparing that with our competitors. So that is the technological challenge, to be able to mass price individual people at speed, which I think the industry has overcome and has provided so far.
Okay, thanks for that. Tamina, your perspective on the personalised premiums, I mean, and also where do you see the personalised premium kind of implies you've got credible data you can base them on, and I'm a bit of an old cynic on this. I can see data and the people produce it, credible or not. So it's a wide range for you to sort of ponder over there for us.
Yeah. So I really think that definitely the future, there's personalized premiums. And because the customers now, they don't want to be paying premiums based on what other people, be it in the demographic areas or same age group, are actually paying, but they actually want it to be assessed entirely according to their customer behaviors. So some of the data that we actually see, or some of the things, the behaviors that we actually looking at, it's if I look at the short term, we're looking at maybe how the customer drives, basically. What speed do they go on average? How often do they use their brakes, and how do they actually use brakes? If they're actually speeding in real time. So those are some of the things that we are seeing. Also, they use the usage-based insurance. It seems to be using quite a lot of telematics to track the real-world driving behaviors. So we're actually seeing this being on the rise, and this real-time data, it's basically its current state is to detect and repair, but the intention of using the real-time data now is to predict and prevent, so that they can transform every aspect of the industry in the process. We're also looking at the sensor data as well, which is actually, we're looking at things like the smart devices, be it the smoke detector or the security systems. That can actually be used at our homes or offices. They can be used to detect the events such as fire and the leaks before they actually happen. So we're actually seeing that there is basically a huge need by the customers to have personalized premiums. There was a survey that was conducted by Essentia to the customers, where they actually, I think about 80% of them, they were actually saying, yeah, definitely we're looking for the personalized offers. We like the personalized messages, the pricing, and also the recommendations from the insurance providers. So we are certainly looking at the future is definitely looking at the the future is such that there will be quite a huge demand, for these personalized premiums from our customers.
Okay, thanks very much. Let's move on to the next question now. And as Joseph, it'll be you up first after my introduction. So we've covered what I call the theoretical approach to it from us as data managers, actuaries, modelers, etc. So we know what is possible. We've now got to recognise we're in a regulated industry. So the question says, how will regulation support or impact the use of such data used for personal pricing? I can add to it then, what do we need to do to ensure the regulator acts fairly and doesn't cause unnecessary challenges for us? I mean, what can we do to work? So, Joseph, I think we all deal with regulators, different approach, but so how do you see it from a UK perspective there?
Yeah, I think the regulators, our practice is well regulated. It complies with the different laws and regulations. Regulations have been supportive in what we are doing. We ask the customers for permission, and they voluntarily provide their information, their health information, blood pressure, and so on, because it is in their advantage in annuities to disclose that. They get more money for their pot, the more pensions. So it is the customers actually want it. And they have given us the permission to obtain medical data from their GPs to validate their information, for example. So I think we have the support of the regulators and customers to obtain detailed information. And it has been in the markets for a while. It is quite common in the life insurance market before the annuities markets. And within the annuity markets, I've not heard of any major problems with customers providing data for us. And we have been keeping that data because an insurance contract is a legal contract, and we do need to keep evidence of how they obtain those prices. So we do keep them for future references and analysis. One area that I might point out is that when the customers don't buy the product, but we still have that information, and it is our practice, a good practice in the industry, to delete the data because it is no longer used. So that is from the ethical perspective. So in summary, I think we have the backing of the regulators. Sorry.
Joseph, I think that's almost legal from GDPR actually as well, but it's we won't have a GDPR conversation here. But yeah, I'm delighted you said.
No. Yes. We are quite strict about when data is not in use anymore, they are deleted. Yeah.
Okay.
Thank you.
So Kettle, from your perspective, and working for a pan-European organisation like SAS, is there any work you are doing or believe you should be doing to help regulators understand it? Because you're sitting on bucket loads of data, I'm sure, as an organisation, and you can help. I mean, I've often found the challenge for regulators is that it's a lack of understanding, so they go back to natural defences, which is logically fine. Is there anything you can do to help them or have done to help them?
Well, I think regulations, I don't know the different national laws in all the countries where SAS is operating. In the Scandinavian countries, there are, for P&C insurance, there are quite strict regulations on what kind of data can be used, for instance, to price a motor insurance policy. So, for instance, gender cannot be used. So you can, if you have, you can be subject to review from the FSA, where they ask you why you have priced these, for instance, two twins, one woman and a man, which drive exactly the same car, the same mileage, and the same accident history. Why you have priced them differently? So there are quite some quite strict restrictions on some P&C insurance, what kind of data you can use. On the other hand, when it comes to life insurance business, I think the regulations in Scandinavia is pretty similar to the UK, that if customers submit data to the to the insurance company that as a voluntarily action. I think that is fine. And I also think that regulators here in Scandinavia are now looking into, for instance, pricing motor insurance with kind of live data, which monitors the driving patterns, as Stabila was mentioning, and how that should be regulated, whether that would be regulated in the same way as biometric data supplied by your doctor for a life insurance policy, or whether it will be special rules for this. I think many cases there are quite new to the regulator, and I think there are some things that we don't know yet how the regulator will react to, or what the laws will be, basically.
Okay, thanks very much. Audience, you're a bit lacking in questions. If you can put some questions forward, it'd be great. We can then ask them. And Tabili, you are on next. I hadn't forgotten you. Don't worry at all. So Tabili, over to you.
Thank you so much, Roger. Yeah. I think then with regards to regulation, what we're experiencing from our side is that the regulator, although he's been working very closely and very well with the industry, but at some point they become a little bit slower, when it comes to some few things. I mean, for instance, we've got the insurtechs, that are being still regulated as brokers, in here. So we then feel like there will be onus on the regulators to support both the innovation in the insurance and also preventing these unsafe products and fostering the new developments. So we feel that the fairness and protection of the private information, which are normally the big themes with the regulators, are still going to be an issue going forward. So we then foreseeing regulators being very strict, or when it comes to the usage of data, which could be often used for, sometimes being labeled as the discriminatory pricing. But also here in South Africa, we've just had POPI, I don't know what you call it, guys, that side, but it's a Protection of Personal Information Act that has just been released now. Yes, and then with that, we are then trying to see how the two is actually gonna map, because we need a lot of data, and in order for us to do any kind of innovation or pricing, we need data. But obviously, we need to always get the authority and the approval, from the client to use their data. So what we are then driving as an industry is to have that very close relationship and the working relationship with the regulator, so that we can work with them to strike that balance that I've spoken about, to prevent the unsafe use of data and the products, but also fostering the new development, because it's a fact that now the industry, the insurance industry, will be tapping into the usage of data big time in order to deliver the service to our customers.
Yeah, I think for me, the regulators, it's how do they cope and what do they expect us to do with the people who are going to get very expensive for personal pricing, and if they impose a cap or sort of an implied cap or maximum premium you can charge, how do we pay for that everywhere else? It's the old classic challenge, really, as to how we do that. So I think that, to me, would be the challenge. I think that would be my worry on the regulators. There's the data side, which I think we've got covered, but it's so you have characteristics, which means your premium is going to be high. So how do we cope with that? If you go to household, it's houses near floods, for example. So UK's come up with a sort of a flood retype scheme there, where sort of all houses in flood zones, they pay a premium and goes to that, and that in theory covers them. So there's something there. I think we shouldn't forget that. Tabili, I think I'll ask you to lead off on the next question, if I may, please. So I think we've covered many of them, but so what are the challenges to be overcome, and not just now, but where do you see us going, and how do we have to manage it?
Yeah, so Roger, like I said at the beginning, that the biggest challenges that we're really having, or that we are facing, is the ongoing changes in the customer needs and the behaviors, and it's the huge usage of the data. If you again back home, there has been a lot of progress around the 4IR, if I can call it that way, and be ready for the 4IR. But because we use brokers a lot, and some of those brokers are like small small entities, so they do not have the technology that's going to enable them, to tap into this data era and be able to service the customers. We're also seeing some of our brokers as well, or third parties, that coming out of business because of the high cost of compliance, as an example. So, and then the economy currently is not helping as well. So we're actually seeing that leg of our distribution being a bit challenged. But from our side, overall as an industry, it's an opportunity more than maybe a challenge to tap into this space of the digital space, understanding, using all this telematics and using the technology, the artificial intelligence and the smart devices and telematics, to be able to assist and deliver on the customer. So I believe that although it's a challenge, but it definitely can be seen as a huge opportunity for the industry.
Okay, thanks very much there. So Ketil, your thoughts on this one. Also, we have some questions in. Thank you very much, audience, for that. So how do you ensure transparency in data usage is one of them, which I think fits into your space, whatever transparency might mean.
Yeah, I'm a bit biased when it comes to that question, I think, coming from the software industry. I would say that ensuring that is a matter of how you set up your IT systems, actually, and what kind of software you use for. So I think having this in the back of your head when you're designing your IT infrastructure and your software systems, I think is key. And I think what we are seeing with a lot of our customers is that once you start to use more data types, which have a different frequency, which comes are updated more often, and you start to integrate models which are used to be worked in with different silos. I mentioned customer intelligence models, actuarial models, and once you start to integrate this forces the companies to think more towards having a tidy structure for their IT systems. And being able to cope with this data, which can come real time, and if you at the same time will use this data to recompute your premiums, so you can supply them to the market real time, it requires good software and good IT infrastructure, I would say. But again, I'm biased when it comes to that question, as you probably understand.
No, nothing wrong with being biased and having an opinion there. Joseph, over to you. There's a couple more questions come in, which probably would definitely fit in your space. They probably fit in Ketil's and Talia's space also. So the first is, how does competitive prices on price comparison sites influence your prices? And that probably gets us back to the price war. And then also a very specific one, did the pandemic change premiums? And so those two, and plus the challenges to be overcome.
Yeah, premium. How does this price comparison changes premium? I think it will change premium. The competitive pressure will make the company wants to be even more competitive, and that would potentially result in asking for less profits for the same segment. But at the same time, price comparison will also allow us to understand the behavioral issues that we just talked about. How much cheaper do I need to be to be the first, and how much more expensive I need to be to lose the business. And there's all these different understanding that can emerge from it. So it does provide what price comparison website does is it provides a new dimension of information and data for us to really serve the customers, to understand what customer wants, how customers feels about these prices, and is there any opportunity for the less tangible elements, like better service, better brand, better security that could attract customers. So the question of do we have any other areas that we can work on apart from prices? So that is the area that we can look into. COVID. will COVID change premium? I suspect so, depending on which products. If risk profile changes, claims increases, we can expect claims to go up. From the longevity and annuities perspective, COVID increased death rates. The issue that we are thinking about for premium is that, yes, we do have excess death. It is unfortunate. But we are not talking about, we are pricing for those who survive COVID. And are they healthier than average population? Because COVID is more dangerous for people with multiple medical conditions. Are these survivals fitter than others? So if they are, the price may have to go up to reflect that. And then we would also ask the question of, are there any knock-on effects of COVID? It has stretched the National Health Service. We know that. It has been reported. There have been delayed in diagnosis and treatment of various diseases. And so we need to ask, is the population less healthy because of the interruption of healthcare system? And finally, we would need to ask, what are the longer term impacts of COVID on the healthcare service? Will it be restructured, and would there be financial strain that as a result would worsen the population's health? And that could be considered. And there may be even surprises, positive news from COVID. For example, improved sanitation. You know, in the UK, we are worried about winter death, excess death. And what we have seen recently is that we've seen potentially reduced incidences of influenza as a result of reduced traveling. People may develop more hygienic habits, washing their hands more regularly, prepared to wear face masks when they are ill, and that could potentially reduce winter deaths. And is that going to be a longer term habitual change that improve deaths? So we have many factors that we've taken into account. Some of them could increase premium and others could reduce at the moment, so it can go both ways.
Thanks so much. Tabile,
interesting to watch.
Yeah. So where are you on these sort of broader issues? So transparency in data, competitor prices on comparison sites, and pandemic. What's the perspective from South Africa on those three?
Yeah, so I think the biggest challenge that most of the insurers are facing is this business interruption component of of our cover. So and we are starting to see some cases coming up here in South Africa where most organizations are losing against the clients, and they actually based on the interpretation. One of the biggest differentiator was that our interpretation was that the lockdown does not really form part of the of the disruption, but the courts are finding it different. So with that, we're probably going to be paying very high, very high claims, and the reinsurers as well might be coming through to maybe increase our our premiums at the renewal, and then probably the challenges or the impact ultimately will be somebody needs to kind of cater for these increases, and we might be seeing we're still observing, but we probably might be seeing an increase then on the premiums based on this of the impact of the COVID, specifically in the short-term insurance space, or the non-life as we are called now.
Okay, thanks very much. So and Kettle, so what are you seeing in the COVID space from the data that you and SAS are sort of picking up on? Is it too short-term yet?
The discussions I've had with the insurers in the Nordic region has been that apart from a very brief rise in claims on travel insurance, there hasn't been much changes to the claims pattern. I think here in Scandinavia, people travel long distance with planes, so they don't travel with planes anymore. They drive cars, but on the other hand, they don't drive cars to work anymore because they're working from home. So I think The impact on the insurers for COVID had mainly been on the financial part because expected return on the investments funds are lower than it used to be. And the financial markets took a very deep dip when the COVID crisis hit. So the concern that Scandinavian insurers have had regarding COVID has been mainly related to their financial investments and not to their insurance policies. So I don't see anything dramatically happening here up here in North with the premium setting for P&C insurance.
Okay, interesting lateral thoughts just come in from one of the questions, which I appreciate all three of you views on. And Kettle, since you're up so to speak now, I'll ask you to sort of answer first. So it says, as we're talking about business disruption, how is technology changing customer service? There's clearly all of us are now working remotely or majority remote, and therefore interacting with customers possibly more digitally than we were before, which is possibly a good thing. But so what's our view there? How is technology changing customer service in this? It's linked to sort of how is technology changing insurance products?
I think especially the sales channels have become more digital. I think this was already happening quite extensively before COVID. COVID has maybe been an accelerator that more sales are done over internet. The human intermediate is no longer there to the same extent. I think that is the most obvious observation when it comes to digitalization and everybody working from home.
Tabile, from your perspective, how's technology changing customer service?
Yeah, I think it's actually enhancing the customer service in my view. We are talking about, the personalized pricing, for instance, and we're talking about being able to monitor the behavior and the trends of the customers. That can only be enabled, by the technology. If we also want to talk about the usage-based, insurance, for instance, we need technology to be able to track, from the short term, we need technology to be able to track those driving, like behaviors, for instance. We need analytics, to be able to analyze these things, to be able to price. So I really believe that it is actually enhancing the delivering of the customer service, the delivering of the service to the customers, basically. And that's why then I'm believing that we should be tapping on it, because we're one of the industries that have been a little bit behind when it comes to technology, but actually it's a great space for us to play in order for us to deliver the service to our customers. And the customers are also kind of like demanding this. They're demanding the speedily response on some of these things, and they can be only enhanced. Okay, we can only do that if we've got technology. They don't want to spend a lot of time. We talk about the comparison, the real-time data. All of those things can actually be enhanced by the technology. So it is actually a big opportunity for us as the industry to tap into technology.
Okay, thanks. And Joseph, your perspective, please, from the sort of the products you offer.
Yeah, I'll just probably touch on three areas. The first is I think technology has enabled us to demonstrate that we are resilient in sudden, unforeseen circumstances like the COVID pandemic. Our customers received their pensions, so it did sustain that. People were able to work from home and also continue to serve the customers. And in terms of the customers who want to buy something, they are able to use technology to understand the prices of that suit them with multiple providers, so they get the information very quickly so that they can take into consideration of their circumstances, and it enables them to seek advice. So some of them may want to obtain information online, the prices, but before they buy something, they want to buy the annuities, for example, they want to go through their financial advisors, and that has been happening through Zoom or Teams meeting. It enables that to continue. So I think it's transparency that we talk about there. If they don't like the price the first time around, they can try to understand it. They can change the circumstances. For example, if for annuities, if I want to add my spouse pensions or take it out, I understand how it works. So in some way, it is transparent because it is within their power to change the criteria and conditions to understand how prices change. So I think it has served the customer positively in that we are able to sustain some stressed scenario, and it enabled them, give them the power to choose and generate a more competitive market for their money.
Okay, well, thanks very much. That sadly is the end of our time now. So I'd like to give a great vote of thanks to a great set of panelists, Tabile, Joseph and Kettle. Thanks also to RiskMinds and at SAS for enabling this to take place. I'm asked to remind you the webinar is available on request afterwards. I'm sure details will be sent to you if they haven't already been. And thanks to your audience for listening, providing us the questions, and stay safe. Thank you very much.